This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Okay, everyone. Hope you're well. Welcome to the Smart Property Investment Show. I'm Phil Tarrant, Managing Editor of Financial Services and Real Estate at Momentum Markets. Hope you're well. Getting stuck into 2024. We're here for our regular chat around mortgage financing. Financing, as we all know, is the backbone of all property investment, something I keep a key focus on as I build out my portfolio. And importantly, it's something that you always need to be dialed in and connected to, because otherwise you won't be doing a very good job. As a property investor, joining me back in the studio to give us a sense for what's going on in mortgage land, Eva Lowenzontz from Finney Mortgages. She joins us. We're going to have a bit of a scenario today based on a real client who recently went through a process of refinancing their portfolio. Sounds like they're in a bit of trouble. Really keen to hear what the solution is from Eva. Eva, how you going? You well?
Yeah, good. Thank you. We've had quite a few refinance early on this year, and I think it's something that a lot of people are trying to do at the moment. So it's probably gonna resonate with quite a few clients out there. Yeah.
And people sort of refinancing at the moment. Yeah, it depends who you talk to. We're either at the top of the interest rate cycle, or there may be one more interest rate increase earlier this year before there'll be a period of stability, and some economists are predicting potentially interest rate reductions towards the back end of 2024. We'll work out and we'll know what's happening there as 2024 plays out. But Eva, people refinancing right now, is that still a product of rising interest rates and people sort of stuck servicing the debt and struggling to repay mortgages?
Yeah, so we've had discussion last year about mortgage prison and people finishing off the fixed rate or interest only. So there's a lot of those out there at the moment that are struggling to find a way to get back on interest only, or maybe just a better rate. And there are options out there. It's just a matter to find them. Yeah.
Yeah, there is options out there, and often, so having spoken to thousands of investors, often changing your loan setup means changing lenders. Often a lot of lenders won't want to negotiate with you. They'll be quite happy with the rate they're paying. And if they don't want to help you move to different options and different products, they'll deliberately sometimes make it very difficult for you. And that's not saying there's anything sinister there. Banks are in the business of making money. So if you don't meet their serviceability requirements, what they will do is that they'll happily still keep the facility in place if you can make those repayments, but it might not necessarily be the best outcome that you want. So what we're talking about here is refinancing, whether it's with your current lender or a new lender, but you will find that a mortgage broker will be able to give you a lot more options than going directly to a bank if you've been transacting with them at some time. And I see it all the time where people get frustrated with the fact that banks will give new to bank customers preferential pricing over established customers. And they'll be sitting there going, I've been with this bank for 15 years and they're giving cheaper rates to people who are just starting with them. Why is that the case? And you get a lot of that. So getting better pricing, getting products, getting different products, getting different finance setups often means even moving banks correct. And you need to have an appetite for a lot of hard work if you're going to do some refinancing.
Yeah. Actually, what you said that is very true. But we've seen in the last few months also banks fighting to keep clients, and sometimes offering cashback behind the scene where technically it's not on offer anymore. So there's a bit of a shifting there where banks are also fighting to keep their clients just as much as they're trying to get new ones.
Absolutely. What I find is that I'll go through periods of time where I call up banks saying, I'm not happy with the pricing, you need to get it sharper. And you'll go through the merry dance of doing it. I normally do it every 6 months. It's a horrible exercise because you normally need to wait on hold for a long time in order to speak to someone, and you won't get the outcome that you want. But one of the best places to start, you can even do it on a quarterly basis, is speaking to your current bank saying, hey, I can get this interest rate somewhere else, and you'll need to provide some evidence. Can you meet it before I consider the idea of refinancing? And that can be, to Eva's point, a great way to keep your rate sharp. And it's a really good place to start because you don't necessarily need to go down that refinancing route, but often you don't get the outcome you want. And that's when you need to speak to your broker, Eva, to start a process of refinancing, which is quite painful an exercise if you have a lot of properties, but well worth the exercise. I know I've done it recently using the team over at Finney Mortgages, resetting a lot of our loans to interest only and getting sharper rates. So did I like the experience? No, because it took a lot of time, energy and effort, but am I happy with the outcome? Absolutely I am. So the juice is certainly worth the squeeze, and your team, Eva, over at Finney Mortgages has been very accommodating with me. I'm not necessarily the easiest client to deal with. So thank you.
I heard that.
Thank you. Thank you for all your support and efforts there. And what I'm talking about here is the smart property investment portfolio, which I share on this show. We've refinanced the whole thing. So that's been done. We've consolidated some lenders, switched some lenders, and set ourselves up now for a nice period of time moving forward, extracted some equity, which we're going to deploy elsewhere. But that's outside of this discussion today. So let's chat around this scenario. So from what I understand, Eva, you've helped refinance a portfolio for a Finny client. We'll get into that. We'll just go to a quick break beforehand. Stay with us, everyone. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment, talking mortgages with Eva Loenzons from finnymortgages.com.au or finny.com.au. Go and check these guys out. Mortgage broker doing some great work, just refinanced all of my loans, all the Smart Property Investment loans, doing great stuff. So tell us about this client that you've been working with recently. Obviously, we can't use names because protect people's privacy, so we'll talk about it generally.
Yep.
What's the setup?
Yes, so I made up some close enough names. So we call them Sam and Amy. They are your typical, I guess, Australian employees. They're both in the medical industry, working as one in the lab, one in as a nurse, and they're earning around 9,500K per year. And they accumulated over the years 4 investment properties plus their home. And they came to us quite distressed, I guess. In the last 6 months, all the loans have reverted back to principal and interest, and the fixed term they had, which was like between 1.98% and 2.5%, finished as well. So they came to us with over 2 million in lending, and with repayment that went from, I think it was $4,500 to almost $14,000 per month. So a huge increase from not being able to pay interest only anymore and not being on those amazingly low fixed rate. So a huge difference for them in the last 6 months, and they just couldn't cope much longer with it, and thinking of selling their properties to keep afloat.
Okay, and they were quite distressed, so they had to find about another 10 grand a month in order to pay their mortgages.
Pretty much,
it's a lot of money.
It's a lot of money.
Yeah, a lot of money. And the typical reaction of most people is sell everything and don't have the headache and the burden of that anymore. But that's not necessarily always the right thing to do. Sometimes it is the right thing to do, and you probably want to get some pretty good financial advice around that, speak to your accountant and stuff. But there are ways in which you can minimize mortgage repayments by changing the setup, and no doubt you probably refinanced everything, Eva, as interest-only loans.
Yeah, so that's what obviously we're trying to achieve. Look, they tried a lot of things. They obviously increased the rent on all their properties as rental are going up as well. The lady Amy, she actually got a second casual job to try to keep up with the increase. But it just didn't work. They also went to all their bank and lenders. So as most people, you start with the big 4, and then on the third property, you may have to go to a second tier lender and then a third tier lender. So they had a mortgage risk paper that was close to 9%.
Oh, okay.
So a huge interest rate, obviously huge payments. Doesn't matter how much they increase the rent, it wouldn't be covering anywhere near, the repayments. So they tried with all the lenders to, as you said, try to get better rates and go back on interest only, but they just didn't service. It just just didn't work. Just didn't work out. So when they came to us, we tried to refinance them on, the traditional assessment rates that we've seen in the past, forever. Just didn't work. They were pretty much 30 to 40K a year short of income, which is a lot in terms of getting a pay rise or a second job. So it just didn't work out. But as we spoke last year as well, there is this option of using the 1% servicing buffer, which in this case was like a miracle because it worked. It just passed by a few dollars, literally by a few dollars, but it worked. So we organized to refinance all their loan and sell it back to interest only for absolutely every loan except the owner-occupier property, which they want to pay off, eventually and quicker. As for your debts, Phil, it takes a long time to do that when there is a few properties. You need valuations. You need sometimes to readjust based on LVR. Sometimes there is a week where someone had to take a day off and paid leave, and the banks wants to check why. And there's always something that comes up. So it took a few weeks. Definitely took a few weeks to get it to a point where we could see that it would work. And then we did, and it worked, and we achieved 6.19% for their home and 6.62 for their investment property on interest only. And that saved them close to, I think it was $2,500 a month for the investment property and $700 for their home.
Okay. And that made all the difference then. So they can keep their portfolio intact as it is right now.
Yeah, they could keep their home, they could keep their investment property, and they just feel like they can swim again because they were literally drowning. Yeah.
Yeah. And no doubt. And this goes to the point around how, the influence and importance of mortgage brokers as an enabler for, happiness and the health of families and relationships, because, when you see stress and pressure in families, often a lot of it is the origin of it is financial stress and pressure. So if you can remedy that and make that, minimize that or ameliorate that, that's probably, you're one of the most favorite people is now their mortgage broker, right? Having sort of unpacked and resolved what was a significant issue. No doubt they're still going to have to keep an eye on the family budget though.
Oh yeah, look, it's still not, again, it was only passing by a few dollars a month, literally. So it's still going to be a real budget exercise for them, but obviously not as crazy as having to find an extra 10 grand a month, which they just didn't have. Just not working. So yeah, still budgeting, and then we'll see how we go for the next 6 months to 12 months. And if really needed, maybe they can sell one property instead of selling everything in a panic.
Yeah. So all the loans weren't cross collateralized at least.
No, yeah, they were. We
were
worked on that, of course.
So they were all with a major lender, were they?
There was 3 with a major lender and 1 with First Mac, 1 with Pepper. So 3 of them were cross-collateralized, yeah.
Yeah. You see a lot of that, and that's we've spoken about that. You go and tune into that podcast. We did a couple of them actually on cross-collateralization and the pros and cons around it and all that important stuff. So you refinance it all with one lender? Can I ask which lender? At 6.66, I'm going to say interest-only investment, probably like a Suncorp or someone?
No, it was actually with CBA.
Was it with CBA, was it?
It was with CBA, and CBA is pretty much the only lender out there at the moment that will do interest only on a 1% buffer refinance. Okay. So again, if you are, somebody out there that is not in the mortgage industry, you wouldn't know which lender to go to get that. So yeah, and they did try to get it sorted before with a few banks, and it just didn't work out. But yeah, CBA came to the party here. And and
they were happy to do the deal. So this is the 1% buffer. So what he was talking about is their assessment rate. They're assessing you on their interest rate, or the interest rate plus 1%, the official cash rate plus 1%, whereas typically the buffer has been 3% on top of the official cash rate. So, which they implemented when rates were at all-time low, rightfully, I believe. So they were factoring in the fact that people taking on debt 2-3 years ago on the basis that rates would increase over time. But the theory now is that rates are at the top or very close to the top of the current interest rate cycle. Therefore, they don't need to apply that buffer, which means people are getting serviced at 9+%. So that sounds like a really good outcome. But if you don't know about this, you don't know. And a bank will just go, no, you don't meet the criteria. You got to keep paying what you're paying right now. So that's the reason why you need to speak to a good broker. Did they have impeccable repayment history?
Yeah, that's right. So at this stage they did, and if they didn't, that wouldn't have worked out. So it's really one of the main conditions is that there's no late payment, no arrears, no nothing on any loan that you want to refinance. And you need a good credit score as well. So if you've been struggling already and have a couple of missed payments, this wouldn't work, and they probably would have had to go on maybe financial hardship arrangement and maybe sell one property at least to make it work. So they came to us at the right time to avoid all of that. The other thing they did, which I thought was really amazing and really good from them, is they decided to make extra repayments on their home loan, the principal place of residence, which mean they would pay that off 9 years earlier than the expected time. And that over time is saving over $200,000 worth of interest.
Yeah, I think maybe we should do a podcast just on that, Eva, because if you sit there and play around with one of these calculations, and what you're talking about there is making extra repayments. And and there's some really good calculators out there where it says, it's a principal interest loan. You put all the numbers in and it says if you make an extra $1,000, whatever it is, $500 in repayments every single month repeatedly when your mortgage is due, you really reduce the length of time that you have your loan, which means that you're paying off more interest quicker because you're decreasing the principal. So it's all there, it's visible, you can see it just in the numbers. But if you start playing around with that, and if you start having that question with, considering yourself or your partner saying, hey, if we just put another $700 into our loan every single month, we will have our loan paid off so much faster, and we're going to save so much more money around it. So, if you put the effort in the front end, you can really benefit in the back end. Some people do it by using offsets. It's a different way to do it, which means that the more the offset of the loan, the more that you're paying. If you keep your repayments the same, then you're driving the principal down faster. So these are all different strategies you can use. Eva, I've got some other questions around this. I'll just go to another quick break. We'll be back in a moment. Welcome back, Phil Tarrant from Smart Property Investment. I hope you're well. Chatting with Eva over at Finney Mortgages. How you guys start the new year, Eva? Everyone's sort of refinancing at the moment. What sort of business you do? Mainly refinance or new purchases?
Yeah, a lot of refinance. We ended up the year with a lot of purchases. Everyone, I think, rushing before Christmas. What we've seen so far this year is refinancing and resetting the interest-only period. Lots of this, which I think is very important. If you're an investor and you need the cash flow and you want to keep investing, it's a must. So
and your view towards 2024, do you think if and when banks start reducing interest rates, they'll do it at the same speed they lifted them, or do you reckon it's going to be another spate of refinancing where people are sort of can get because you'll find that to my earlier point, new to bank business, if rates start coming down, they're going to be pretty sharp rates. And I was speaking with one of your brokers yesterday, Rebecca, and she said that I can't remember which lender it was, are already offering fixed rate home loans in the 5% range. Is that correct?
Yeah. I think there's actually there's one or two that are doing that. Yeah.
So when you see fixed rates getting marketed at 2-3 year fixed rates in the fives, it gives some sense that lenders are already factoring in the fact there's going to be interest rate reductions. But that's going to be a really tough decision for a lot of people when they can start thinking about potentially fixing their rates at 5% for 2-3 years rather than the 6% that most people are paying now. Might sound great when interest rates are still interest only. Interest rates you're getting in as an investor at sort of 6.5, 6.6%. What would you be doing? Would you be fixing now, or would you be letting the cycle run its course and stay interest only?
I think it's very, very different for each person. If you are and you feel like you're really struggling with your budget, like the client I had, maybe it would be a good idea for them to fix it, even though maybe after 2 years plus they would have been better off not fixing. At least they know exactly what's going to happen for the next few years. If you're somebody that has, good cash flow and not too worried about an extra increase or decrease, then I would leave it on variable and just, surf the wave down as it goes.
Yeah, and hopefully that is a big wave down. But if you think, you're sitting there thinking, oh, I can't wait till interest rates are back to 2%. Never going to happen. I reckon they'll stabilise into fives for the next sort of period of time. And that's
historically, that's what it is.
That's historically where it is. So you should be doing your budgets around that. So if you're taking on new debt now or refinancing, you're doing it on the basis that it's probably the repayments that you're paying now are probably higher than what they will be in 12 months to 24 months time. But if you can meet those repayments now and look at refinancing and recalibrating your debt profile, it's well worth having a chat to a good broker like Eva and the crew over at Finney Mortgages. So what's next for this couple? So you've saved them how much a month in interest repayments?
Yeah, so it would be close to 3,500 altogether.
That's a lot of money.
Yeah, it's a lot. It is. It is huge, and that's why they decided to make extra repayments, because they felt like, well, that's not what we expected. They didn't think it was possible in the first place, and two, they didn't think it would be such a big difference. But when you think of the 9% with PEPA compared to 6.5% with CBA, obviously that is a huge difference in the repayment. So, and the other thing is, as the rates go down, and probably we'll chat about that later this year, but if you've been okay to pay your home loan on, let's say, 6.5%, and next year it is 5% or 5.5%, you should try to actually keep making the same repayments that you used to and really smash those mortgage down as you go. If you were okay, if you were struggling, obviously different story, enjoy the break. But if you could, it would be great to start making those extra repayments. It goes straight to the principal and gets rid of the mortgage.
That's great. Such a great debt reduction strategy doing that, Eva. So if you can normalize your repayments at the maximum, which is around now, and maintain that for the next period of time as rates come down, you will take years off your mortgage and thousands and thousands of dollars in interest repayments.
Yeah. So in this case, this client, just to give an example, their home loan was just under 500,000, and they decided to make extra repayments of $100 a week. Right. And that's taking off 9 years of the mortgage.
So $100 a week takes 9 years off.
9 years. And that is on a $500K mortgage, $200,000 worth of interest. So it's huge.
Did they reset the length of the mortgages?
Yeah.
Okay.
Yeah. We had 2 years, 30 years on a 30 years mortgage. Yeah.
So 30-year mortgage. So 5 years interest only, then 25 years P&I. But they're also, except for the principal place of residence, was P&I for the 30 years.
Yeah, from day one. Sorry, yes. So basically, they will have paid the mortgage in 20 years or 21 years now.
Yeah. Okay. So that gives them a pathway. It gives them a pathway to being debt free on their principal place of residence. And what I find is when people start chipping away at that and see that number change, they go, "Oh, I reckon we could manage 200. Oh, I reckon we can manage 300," and they get obsessed about it. I wish I did it more often. So how do you actually do that though? Because normally the bank just charges you whatever the repayment is.
So the few things you can do is actually, one is to change your repayments to weekly instead of monthly.
Yep.
And that means you'll have a few more repayments per year, which again is a way to get it done a little bit quicker. That's only worth it if it's principal and interest. Interest only won't change anything. So weekly repayment, and then instead of having a minimum, that the bank would charge you the minimum, just set a repayment yourself. Let's say your minimum repayment is $1,200 or roughly that. You just set it up as a $1,400 a week or whatever it might be. And the bank will take whatever amount you nominated as long as it's above the minimum repayment.
So how do you actually do that? Do you need to, they'll just always do the minimum. Do you need to then proactively put money into the loan account, or
you can ask them to set up an automatic debit that is higher, and you nominate the amount. Most banks, you can do this on the app, just change the repayment amount from minimum, compulsory amount to whatever that is. Yeah.
Okay.
It will take a second, literally a second on the app to change that.
And what you find also is that when rates start coming down, a lot of banks won't reset the minimum. They'll just leave it as it is. I know Pepper does this. When rates fluctuate, they always go, whatever you set the repayment is at the time of the mortgage, even if it's cheaper, they'll still charge you that anyway and drive it down. But you need to be proactive with this. It's well worth looking at. Spend some time, over a glass of wine, playing around with one of these calculators, and just do different scenarios of increasing your repayments, and you'll see very quickly how quickly you can make an impact. If you've got good discipline, offsetting your loans, but then keeping the repayments the same is another way to do that as well. So the bank will always, but the minimum repayments, so if it's offset, will just be if it's interest only, whatever the minimum is for that moment. So you actually still need to tell the bank to change your rates, right?
No. If you if you have money in offset, which is again something different, and let's say your minimum repayment is $1,100, you had some money in offset, so it actually comes down to $900 per month. That's all they will take, even if the minimum with no offset would be a bit more. But if you tell them, I want you to take $1,200 a month, that's what they will take, regardless how much you've got in the offset. Yeah, and it's been actually, I've read some studies that shows that if you do have money in the offset, you are less willing to pay down your mortgage quicker because you feel like you do have extra cash there and you're spending it somewhere else. So if you feel like maybe you're lacking discipline a bit, the extra repayments are probably a good way to go.
However, if you need that money, though, often you can pull it back out as a redraw, correct?
Redraw, yeah. It's less accessible than the offset, but it's just a bank transfer, really.
Yeah. And most, and again, speak to your mortgage broker, not all mortgage products have redraw facilities. Sometimes for no frills products won't have redraw. So you put that money in there, you can't get that out other than refinancing it. But whereas, if there is a redraw, it means that you have paid down the principal, but the money is available just in case of a rainy day. So, redraws and offsets. Maybe we should do another session on that, Eva, just so people can understand the differences of them. But both of them have a similar outcome, but they're just different. how you can sort of extract that money. And sometimes, it can be a bit of a challenge to get redraws out, or it might take a little bit longer than just sort of pulling it out of an offset.
Which can be a good thing if you are a spender. And
Yeah. It can be a good thing if you're a spender to actually make it harder for yourself, like put barriers in place. And then again, people that do this really well, they just go, we won't compromise on these mortgage repayments. Let's just do it, commit to it, pay overs.
Because you forget about it after a while. It's been debited every month as a higher amount, and you don't even think about it.
It just normalizes, right? Completely normalizes.
Yeah.
So,
and I think that's the key for success, I guess, to pay off your mortgage a lot quicker. And imagine those guys, like in 20 years now, in their 40s, they will literally retire without a mortgage, which they wouldn't have otherwise.
Yeah.
So if they can keep doing it and it's going to be an automatic payment, just forget about it, then they really are a good way.
Yeah, and what I find also for property investment strategy I do is that I try, interest-only loans are great, and I'll offset them with cash that I may have because I'll, want to have capability to leverage it to use for other purposes. However, what I like doing, and it sort of works for me, is that I try and sort of balance the principal component or the repayments. So the rent largely offsets the debt. So that works well for me, where I don't want to pay the loans off. I want to maintain the debt, but I'll try and push down the principal component of the loan, so the interest repayments against it every single month is the same as what the rent is, or thereabouts. And I'll factor in how I might be able to get some tax benefits from that as well. So largely trying to make them cost neutral, so you can retain the debt. And I know a lot of lenders now, if you've got, we spoke about it last year, if they're in trust and the trusts are positive, they'll just go, I won't worry about that. So it means you can amplify your borrowing by having positively geared trusts. That's another strategy there, but that's a bit more at a sophisticated level.
Yeah, but it's very important though, because a lot of people, and I had someone else again this week saying, how do people on the average income keep buying property? And the family trust setup is definitely one of the key to that. That's definitely something you need to chat to your financial planner about. And there's no advice there coming from mortgage brokers, but that's the way, and that's how we see people doing it.
Yeah. So that's when you get a little bit more sophisticated in your strategies around being a property investor. But, one of the simplest, most immediate and impactful tactics that anyone can deploy is, if you can, overpaying on your repayments for driving down. Because most people are looking for some sort of debt-free solution into the future, overpaying where you can and normalizing that so you don't notice it, and shaping your family budget around it. And you will be surprised how quickly, if you're paying your repayments that they are and extras, how quickly you can drive down the principal, because more of your repayments are going to paying the principal component. Huge impact. Eva, I always enjoy catching up. You and the crew over at Finney, I know you've got brokers everywhere doing heaps of stuff. You still got some capacity for helping out more people to borrow if they're sort of, they're going, oh, hang on a second, that sounds like me. I really need to refinance my.
Definitely happy to help. We're also looking for another broker, actually.
Okay. Oh, there you go. It's a recruitment podcast then.
Recruitment podcast. You never know. Maybe someone there is listening. But yeah, we do, we love doing refinancing, and that, to me, that's so fulfilling to help somebody that could have just gone into the panic mode and ruin what they've built for the last 10 years. So yeah.
Oh, the team of Finney, excellent. And I've said it before on this podcast, but for those of you that don't know, I use Finney for all of my mortgage, and they do such a good job. I decided to invest in the company. So, I put my money where my mouth is, and Finney do it well. So keep doing it well, because I'm a happy shareholder, Eva.
Yeah, that's good. That's good to hear.
I'm a happy shareholder, but good to catch up. How do people find you if they want to have a yarn?
So they can give us a call, or I guess the easiest is to go on finney.com.au and request an appointment, and you'd be put in touch with one of the broker there to see what we can do.
How do you spell Finney?
Finni.
Is that a French term for something?
No, I don't think so.
it's what's petit miam? It's what's that? It's French for yogurt. Maybe you need Finney. It's French for finance or something like that.
French for finance.
Oh God, let's not go there. Nice one, thanks, Eva. So it's finny.com.au. Go and say good day. Tell them I sent you. They'll look after you. But it doesn't matter whether you know me or not. I've had a really good experience. So I actually settled on a property in a week's time that you guys helped me out with getting a loan with Rebecca. So she probably needs a holiday now after working with me. So
you probably need to send her some wine too.
yeah, no, well, she knows I appreciate all of her hard work and effort, but I'm not the easiest guy to work with sometimes. But anyway, so if they can work with me, they can work with anyone. Anyway, thanks for tuning in, everyone. Remember to go and check out smartpropertyinvestment.com.au. Smart Property HQ is where you find us if you like us on the social media. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.